Good afternoon, good morning, everybody.
Good afternoon, Sandy.
Hello. We have a good group here. And of course, very interesting questions we will try to answer. These are the questions, the answers to which really mark us as rating agencies, different from all credit evaluators. So, noting that it's already time, I would like to start our Chief Rating Officers Roundtable. This is part one. And we have on stage 6 of our Chief Rating Officers from 6 different rating agencies. So this is a beautiful mix. And here are the topics and the speakers. The first part will be on the monitoring of credit ratings, practice, and issues. The first speaker will be Ms. Angelica B. Viloria, Officer in charge of Philippine Rating Services Corporation. She is, in fact, the Chief Rating Officer, Head of Ratings of Phil Ratings. And Mr. Henro Otomo is the Rating Director for Pafindo. In the second part, we have a second topic, independence and objectivity in ratings. And we have 2 speakers here. The first one will be Mr. Rajaseharan Parameswaran, Chief Rating Officer of Malaysian Rating Corporation, better known as MARC. And then Dr. Sarnamba Roy, Chief Rating Officer of Informatics Valuation and Rating Private Limited of India. The third topic will be on the application of consistency in ratings, practice, and issues. The first speaker will be Mr. Sakin Gupta, Chief Rating Officer of Care Ratings Limited of India. And the last speaker will be Moj Asiful Haq, Chief Rating Officer of CRISIL, Credit Rating Information and Services Limited of Bangladesh. So we have a full day today. The general pattern of our program will be each speaker will be given 10 minutes to speak, and then that will be followed by 10 minutes of open forum on the subject. And that will go on 10 minutes first speak and next speaker, another 10 minutes with a speaker, 10 minutes for an open forum, and so on. That will bring us, if we follow strictly this pattern, that will bring us to 3:30 p.m. Manila time. And we have 30 minutes more of open forum for any and all kinds of questions. So, but this is a pattern. So we will, of course, be a little bit flexible on this. We cannot be so strict on the minutes, but I just would like everybody to just to be aware that we do want to end, as promised, by 4 p.m. Manila time. But if the conversation goes very interesting, it will be up to us to an overtime, as we wish. So with that, let me welcome everybody to this first ever Chief Rating Officers Roundtable. And I would now like to invite Ms. Angel Viloria of Phil Ratings to make her presentation. Angel, please take over.
Good afternoon, ACRAA colleagues. I'm Angelica Viloria from Phil Ratings in the Philippines, and I would like to thank everyone for being here this afternoon. I've been requested to share on the topic of the monitoring of credit ratings, practice, and issues. For this 10-minute presentation, I will cover the following points. What is the rating agency doing in this area? What issues or problems are expected or being encountered in this area? And what does the rating agency intend to do in this area moving forward? Regular monitoring is an important part of the rating process. It is a way by which the analytical team is kept abreast of company and industry developments and will ensure that the ratings assigned remain appropriate and up to date. Regular announcements on a particular account communicate to the market that such assigned ratings are reviewed on a continuous basis. What is the rating agency doing in this area? Since the time that Phil Ratings started the credit rating function in 1985, we have put in place several improvements in relation to the monitoring process. The responsibility for the continuous review of a particular account rests with the analytical team in charge of an account. While there is a formal annual monitoring process based on a set schedule, this process can start at any time based on the analytical team's prompt, considering company, industry, or even global developments. Let us take this COVID-19 pandemic as an example. The Philippines has been under lockdown since March 2020. Mobility restrictions and health protocols led the Phil Ratings team to work from home and also affected the operations and performance of the companies we evaluate. One of the first things that the Phil Ratings analytical team did with the onset of the pandemic was to do a quick review of all its accounts to see how the companies are coping with the pandemic and what the effect of this may be on their business and their capability to pay. In relation to the restrictions imposed by government, Phil Ratings classified each company's business into essential, partial essential, or non-essential. The team also came out with standard COVID-19 related questions that we sent to all our covered companies. Some of these questions are: what strategies or adjustments have been put in place given the COVID-19 pandemic? At what level of operations is the company operating, and what will be the effect of such on profitability and cash flows? By when do they expect company performance to go back to pre-pandemic levels? Sorry about that. On a regular basis, continuous monitoring is done by looking at or considering the following: regular quarterly disclosures on performance and operations that are submitted by rated publicly listed companies to regulatory bodies like the Securities and Exchange Commission and the Philippine Stock Exchange. Direct requests by Phil Ratings to the companies for other information needed to monitor the account, particularly for non-publicly listed companies that are not required to do any disclosure. Various sources of company, industry, and economic news. The comparison of the company's recent actual performance versus projections submitted for the initial rating exercise. The comparison of the company's previous versus updated projections to see how their views of the industry and their business have changed. The comparison of the company's interim financial performance versus its most recent set of projections. The tracking of maturities of rated securities and communicating with companies on the sources of payment for these prior to the maturity date. Confirmation of payment being made for a rated debt upon maturity, and peer comparison or comparing the performance of a rated company with other players in its industry. Such information will be used by the analytical team in doing a formal review of the rated account at least once a year. Results of the annual review will be submitted to the relevant body which needs the credit rating and will also be published by Phil. What issues are being encountered in this area? In terms of challenges in doing regular monitoring, it is at times the availability of updated industry and peer data that may limit the regular reviews done. For peer comparisons, for example, there is a delayed submission sometimes of the audited financial statements such that if you are doing a review in 2021, the audited FS for a particular peer in 2020 may not yet be publicly available. Non-listed companies are also not required to file quarterly disclosure with regulatory bodies, so it is harder to source data if the company will not provide this to the rating agency in a timely manner. Furthermore, while there is a regular schedule for the formal annual monitoring, barring any significant positive or negative developments which will require Phil ratings to fast-track the review, a company may take more time in responding to the rating agency's information requests since there is really no urgent requirement on their part, unlike during the initial review when they had the timing to meet for their issuance. In this case, Phil rating assesses whether there is enough basis to do a full review and update, and may consider information risk or the lack of information in assessing the risks in relation to a particular account or transaction. What does the rating agency intend to do in this area moving forward? Phil Ratings recognizes that the world has become smaller and developments are faster, making the regular monitoring process more demanding these days. There are also events that are hard to predict and which have changed the way that we view particular businesses. For example, prior to the pandemic, the view was that educational institutions or schools and malls are assured of steady continuous demand. With the COVID-19 pandemic, however, Phil Ratings has seen the effect of such on schools and mall operators' performance. Key to doing a better monitoring is access to an organized repository of historical and projected data. Phil Ratings would then like to move towards having a centralized database for the economy and by industry and per company. While we are able to access available data needed for particular industries, it would be helpful if such can be updated regularly in a system that can be accessed by all. For example, we evaluate certain property developers whose projects are focused on particular areas in the Philippines. To complete our monitoring of such accounts, the analytical team in charge would discuss regional gross domestic product for the region where these areas are located, tourist arrivals, and other developments in these areas. Given that it would be helpful if the RGDP or tourist arrival figures over time historically and projected figures can be accessed through a single centralized database that the analytical team can use. With that, we can have more extensive studies on industries that Phil Ratings covers, and we can have a better review of all companies we cover in the same industry and identify more closely key trends and vulnerabilities before we do the formal monitoring for a particular account. With more data on accounts and industries, we can move on also to credit analytics and modeling, which may allow us to identify warning signals in relation to a particular account or anticipate developments for a particular industry better. Such will also allow us to respond faster in case of events of systemic risk. Such, however, may necessitate looking into setting up a separate research unit or function with dedicated researchers and economists to support our main analytical team. At present, the main research on a per industry or company basis is handled by each analyst or analytical team, which allows the analysts to be closer to the industries that they follow and to build their industry knowledge and expertise. While Phil Ratings has already set monitoring practices in place, we recognize the need to continuously review our monitoring process to ensure that we are able to evaluate all existing accounts efficiently and effectively. The team will need to balance such moves to improve and enhance the process with the size of our team in terms of manpower and the volume of accounts and demand for rating services given the overall situation in the Philippines and in the capital market. Should you have any questions or comments on the points mentioned, please let me know, and I'll try my best to answer your questions or respond to your comments. I would also be interested to hear from you on what you have done in your own rating agencies to enhance or improve your own monitoring process. Thank you very much for your kind attention and a good day to all.
Thank you, Angel, for your presentation. Now, could you hold on to your questions first, and let's listen to Henro Utomo on the same topic, and then we shall have entertain your questions on this topic. So may I call on Henro to make his presentation?
Yes, hello. Thank you, Mr. Santiago Dumlao, and good morning, good afternoon, ladies and gentlemen, distinguished speakers, members of the ACRAA. Again, thank you for giving me the opportunity to share with all of you ACRAA members what PEFINDO is doing in related to monitoring activities on the credit ratings. I believe other ACRAA members may have the same practice or even a totally different approach in this particular activities, and we are very keen to hear the feedbacks and comments from all of you. And for this 10 minutes presentation, we'll divide it into two parts. The first two slides, I would like to share the regulatory background related to the rating assignment and also the monitoring activities of the rated entities or rated instruments. And the following 4 slides will show how PEFINDO conducts monitoring on the credit ratings. And also at the end, I will share with you what issues are faced by PEFINDO in conducting this activity. Yeah, I hope all of you have seen my screen.
Yeah,
So,
yes.
So this is the agenda for this presentation. So what I can share with you in Indonesia, credit rating is a mandatory requirement for publicly offered debt issuance by corporation, and not only for the issuance, but the rating is also must be available, or the instrument itself must always be rated until the maturity. The next one is that the debt issuers and as well as the credit rating agencies must ensure that the credit rating information for the debt instruments are publicly available. For the non-publicly or the privately offered corporate debt, the credit rating is not a mandatory, it's an optional, but the issuer can use either a credit rating, or if they prefer not to use a credit rating, they must the debt must be covered by adequate collateral. In terms of the publication for the privately offered debt, it is also optional, subject to the consent from the issuer. The credit rating agency is obliged, or it is mandatory, to continuously monitor the rated entities and the debt instruments. And one thing that's also quite interesting, that in here we the regulator limit the period of the credit rating. It is up to 1 year. So if the debt instrument, let's say it's a 3 years instrument, then we can only provide the rating with the period of 1 year, and the next for the next year it must be conducted annual monitoring. So and for the corporate public debt issuer, they must provide or disclose publicly the year-end audited financial statement, It is also mandatory for banks and also for the publicly listed entities. They also must disclose the quarterly financial statement, also applies to banks and the publicly listed entities. The corporate debt issuers also must inform whether there is a material information. It is also mandatory not only for the corporate public debt issuer, but also for the publicly listed entities. And the corporate public debt issuers also must disclose the repayment plan for its maturing public debt. So this is the regulatory background on the our activities in conducting the monitoring for the credit rating. So the first activities, as I mentioned earlier, is related to the limitation of the rating period of 1 year. It is require us to conduct an annual review for the rating, particularly for the debt instrument that has the tenor of more than 1 year. So the annual review is required to ensure that the continuity on the rating for the debt instrument to avoid that the debt instrument becoming unrated, because it is not allowed for the public debt to be unrated. So for the annual review process, we will do the annual review within 10 business days after the end of the rating period. Although ideally it must be done immediately after the rating period has ended. And we require the client to submit the data at least 1 month before the end of the rating period. And for this annual review process, we also require a direct interaction with the client. It can be in the form of the site visit, and also it is mandatory to conduct the management meeting with the client's board of directors. And as the output, as I mentioned earlier, that the rating result we expect to be finalized, or we targeted to be finalized within the 7 business days after the end of the rating period. The regulator itself limits up to 10 business days, but internally we make it shorter to 7 business days to ensure the compliance with the regulation. And also we will make the rating publicized within 2 business days after the rating committee meeting. So it is also to comply with the regulation that rating agency must make publication of the rating within 2 business days for the published rating. So this is the annual review process. And the next one is the quarterly review. So the background why we are doing this, I think it's quite clear that we want to make sure that the client's performance based on the quarterly result is still consistent or in line with their historical result and also their business projection. And we need to also make sure that the rating that we have given to the company or to the rated instrument is also still consistent or relevant. And we will require this quarterly review mostly to the debt issuers, either it is a public debt or a private debt. We will also conduct a quarterly review to publicly listed companies, even though they are not issuing any debt. We are also requiring this to banks, because banks has a very strong disclosure of information. The information is updated even on a monthly basis, so we can easily get the information from the banks. And the last one is that we will require the quarterly review for the clients with a published rating. So even though it is not a bank, it is not a debt issuer, it is not a public listed company, but if they decided to publish the rating, then they must comply with the requirement for the quarterly review. So in the process, it's mostly relying on the publicly available data, although we still will request for the clients for additional data if it is not available in the public. And direct interaction with the client is on the need basis. So it doesn't always we have to meet or contact the client for the further clarification. But if the analyst believes that they need further information, then they will arrange the meeting with the client. For the targeted timeline, we are expecting to finalize the quarterly review within 1 month after the data is available. So in terms of the publication, we have this policy that if the rating has not changed from the last rating, there will be no further action related to the publication. So it means that the last publicized rating is still valid. But if there is a change based on the quarterly review, whether it is a rating change or an outlook change, then of course we will have to inform the client regarding this rating action by sending the new rating certificate and the report to the clients to explain what are the factors that affecting the rating or the outlook change. And for the published rating, we will publish our rating committee result related to the changes of the ratings. The next process or the monitoring that we do is related to the maturity of the debt instrument. So in these activities, we will emphasize on the issuer's readiness in repaying certain rated debt instrument maturing in the near term. So the process, we will try to get the latest information on the particularly the source of repayment for the maturing debt, and it can be indicated by certain information such as their liquid asset position, whether they have unused credit facilities, how about their cash flow from operation in the near term, whether it is sufficient to support the repayment. Also, we will check whether they have assets that are still uncollateralized, which can be used maybe to obtain new borrowings, and whether the company has related corporate action plans to support their repayment. We will do the debt maturity review within 2 months before the maturity date. So the committee will decide whether the company has the adequate source of repayment to support the maturing instrument. And if we decide that there is a readiness to repay the debt, of course, it will not result in a rating upgrade because it means that our rating has been in line, or the outcome has been in line with our latest rating. But on the contrary, if there is a lack of information or the information indicates that the company has not prepared for the repayment of their maturing debt, it may trigger a rating downgrade, and in some cases it can be a multi-notch downgrades and also the change in outlook. In our policy, we usually put the outlook as the credit watch negative if such case occurs. And we will also publish the debt maturity, our result on the debt maturity review within 2 business days. So whether it is decided that they have adequate source of repayment, or if the company still on the process of the repaying the maturing debt, we will publish our result on the debt maturity review. So this is the next one. It is the special review, or we call it incidental review, and this will be triggered by any material information which, based on our initial assessment, can potentially affect the rating. So we will try to get information from the publicly available data. We have a stock exchange that in their website, they have a section for the information disclosure, and basically we will source on that information, but we will also look from other sources as well. So in this process, first we will decide in our small committee whether that this material information has the potential to affect the rating. And if that is the case, then we will inform the client that they are currently under special review. And we will try to make a direct interaction with the client, but the regulation for the special review is very, very tight in our case, because the regulator mandate rating agency to finalize the special review only within 7 business days. So if there is no time to make a direct interaction with the client, then we will still have to finalize the special review process. And for the published rating, the information on the change of the rating or the outlook will be made available to public also within 2 business days. So this is a very critical process, and because of the very tight schedule, we must do this very delicately. And this is, I think, my last slide. So what happened, or what are the issues in conducting the credit rating monitoring? I think the first one is very classical issues. There will be asymmetric information disclosure. Clients will have the tendency to hide negative information, and they are more willing to provide information if it may positively affect the rating, or when they need the rating for the corporate action. And as I mentioned, we also try to find the information from other sources rather than the official ones, but the media-based information in our cases tends to be needs for a further clarification for accuracy, while the special review process, as I mentioned, must be concluded within a very short period of time. As the credit rating agency, we also has limited access on the debtors' credit information provided by our banking regulator, while the banks have those accesses, but rating agency, we cannot has the similar access as the banks. And in Indonesia, we have also credit bureaus for the individual or the company credit scoring, but also until now, we have not been allowed to access this information as well. So what we do is that we mostly rely on the information disclosure published in the stock exchange website, although it is only for the publicly listed company and the public debt issuers. And we are also trying to strengthen our contract or the agreement, business agreement with the client, to ensure that they understand their obligation to provide the information to rating agency in the requirement for the rating agency to maintain their rating accuracy and also public disclosure. Yeah. So otherwise, if they cannot comply with the requirement based on the business agreement with the rating agency, it is also possible that for us to stop the rating exercise and withdraw the rating. So it will be not a very good situation for them if they have a public debt and the rating agency withdraw the rating. So I think that's one of the strategy that we can do to maintain the client still cooperative in providing the information. So I think that's all my slides. Thank you for your attention, and we are very welcome for any comments or feedback, and also sharing your practices as well. Thank you.
Thank you, Hendro, and thank you, Angel. I now open the floor to questions, comments, or your own contributions. So we have a chat box there. As usual, I will ask Farial to help me in these open forums. Does anybody have a question, comment, suggestion? Just put it in the chat box, or you can raise your hands. Rajan, you have something? You look.
Yeah, I just want to check
There.
with sorry. Yeah, with Hendro. Can you hear me?
Yes, yes.
Yeah.
Clearly.
Okay. Just you said you will publish the reports within 2 working days, right? So is it the reports or is just the announcement of the ratings, the decision, or is it the full reports that you publish within 2 days?
Okay. Can I directly answer that?
Okay.
Okay.
Any other questions? Chong?
Yes, please go ahead. I think you can answer that question, right?
Yeah.
Yeah.
Okay, thank you,
Hendro?
Rajan, for the question. So, yeah, what we mean by publishing the rating result is we have several versions of the report. So, what is published within the 2 working days is the shortest version. We call it the rating release. So it's like a half-page report. We also have the other version is a longer, maybe 2 or 3 pages report. We will publish it within, I think, 1 month from the rating decision. Yeah, because it is not mandatory, or it is not regulated in terms of that long report. But the rating agency is required to publish the rating result and also the explanation on the or the rationales why they decided such rating. So that's what we are trying to comply is the 2 business days. I hope it answered your questions.
Yeah. Just a follow up on that. What happens if the clients, do not agree to rating, within the 2 days? They appeal on that rating decision? What happens?
Okay. So for the monitoring activities, whether it is annual monitoring, quarterly, or a special review, there is no option for appeal. So the client has no cannot object. So they will. We will anyway will publish the result. Yeah, whatever the outcome. So the appeal only applies for the first time rating. So when we rate them for the first time, or when there is a first time issuance, they have the chance for the appeal. But for the other monitoring activities, they cannot make the appeal.
Okay, thank you.
Welcome.
Angel and Hendro, one of the challenges you mentioned is that you may not have sufficient information to update your rating. And you say, Hendro, that you depend largely on the stock exchange and Sometimes the ratee themselves do not want to share the negative information. What do you do, Angel and Hendro, if you find that the information you need to update is not available or the rating does not give it to you? Angel first.
In case there are missing information, Mr. Dumblao, the first thing that the analytical team will try to determine is if there is even enough information to arrive at a rating conclusion. If the answer of the analyst is that even if there may be missing information, there is a significant amount of data on which to make a rating decision, then we can assign a rating based on available information. But in cases wherein there is really not enough data or not enough basis, then the ultimate decision might be to withdraw the rating. Although in the case of field ratings, we haven't withdrawn ratings in a long time, and it's also something that we don't want to do because as a rating agency, our position is that for as long as the debt is publicly issued, then it is our responsibility to continuously inform the regulators and the investors of updates in terms of the credit standing of the company. So those are the only things that we can do if there is not enough information.
Hendro?
Yeah. So I think mostly the same with what Phil's ratings has been doing. So we will try to conduct or decide the rating based on available information. However, we have some process to remind the clients to submit information as much as possible to us before the time when we need to conduct the rating decision. But in the case of the information is very limited and it is not possible using such a limited information to decide the rating, we will also inform the client that this situation may force us to withdraw the rating. And if such things happen, usually the clients will start to be more cooperative if we already send the letters. But in a rare case, we did withdraw the rating eventually if there are still no adequate information to support us in deciding the rating. So I think that's what can I answer.
Okay.
Thank you.
Thank you, Hendro. We can have more questions a little bit later towards the end of this roundtable. For now, thank you very much, Hendro and Angel, for your presentations. Can we now move to this second part, another topic on independence and objectivity in ratings? So may I call the first speaker, Mr. Rajaseharan Parameswaran, Chief Rating Officer of MARC, to make his presentation.
Thank you, Sandy. Good day to all of you. It's a very interesting topic, independence and objectivity. All credit rating agencies, our reputations rest on those two factors. Let me share the slides. Okay, can you see the slides?
Yes, we can.
Okay. Yeah. Before I start here, just give a little bit of background on MARC and on the background in which we operate. MARC is licensed by Securities Commission of Malaysia to operate as a CRA. We are also recognized as an ICAI by the Central Bank, Bank Negara Malaysia. And as a CRA, we operate under a framework established by SC that was revised in 2006 and later in 2011. I suspect that the first revision in 2006 was due to taking stock of the lessons in the Asian financial crisis. The second one in 2011 was just after the great financial crisis, the global financial crisis. So maybe the third revision is due in a few years' time from the lessons from the COVID-19 pandemic crisis. So what does SC expect from Mark? To summarize, all of our credit rating activities are to be conducted in accordance with the principles of integrity, transparency, quality, and good governance. We also need to abide by a stringent set of regulations that can be onerous at times, but to adhere to the principles of independence and objectivity. The results thus far, how have we fared? To date, we have rated 765 issues worth 614 billion. Contains many types of ratings, corporate credit ratings, issuer ratings, structured and project finance ratings, alongside with a lot of financial institutions. So in carrying out our work, what are the frequent issues and challenges we face? Firstly, rating shopping, right? So rating fees are paid by issuers under the issuer pay model. Therefore, it is understandable that issuer will strive to seek, the best rating, the highest rating possible. So what they can do is to go from one rating agency to another, dangle the rating mandate to whichever rating agency is willing to give a better rating, a notch higher, so on. So that is a practice that issuers can do. So as a rating agency, of course, we have to be very vigilant and to assess the factors as they are in terms of both the qualitative and quantitative. Another factor is, of course, rating inflation, where the rating agency, in order to gain, say, market share for their own KPIs or to impress their stakeholders, can be pressured to offer higher rating, right, to attract new clients as well. Again, this is something that we have to always be vigilant to guard against, that whatever ratings that are given are purely merit-based, and there should never be a perception that this is done to gain some sort of a leeway in terms of a market share. Distortion in debt capital market. So this can happen when we give a certain rating and market does not think that the rating reflects the credit risk. So what can happen? The bonds may be traded at yields that are not warranted as per the ratings. So when these anomalies occur, it raises questions on the objectivity and the timeliness of rating actions. So we need to be vigilant in that respect. We have to see that whenever we give a certain rating and so on, how are the instruments performing in the marketplace? Are they reflecting the assigned credit strength? So if it is out of sync, then we need to then look at in terms of whether timeliness of rating actions are being implemented. So a lot of issues that needs to be addressed. Another factor is investor risk aversion for lower rated bonds. This is peculiar perhaps to the Malaysian bond market because of the risk of credit weakening or default is higher for lower rated bonds in the BBB or the A category. Issuers have shunned such issues since the global financial crisis. The result is that issuers with weaker credit profile are unable to issue rated bonds. So they opt out by issuing unrated bonds. So we have a situation here where the Malaysian bond market, corporate bond market, is characterized by high rated bonds on one side and unrated ones on the other. So for the unrated bonds, they pose some issues in terms of who does the surveillance, and the lack of which can be detrimental to the overall health of the domestic capital market. There are some other challenges we face. Maintaining transparency and consistency in rating decisions. This is important to convey that all of our rating actions are undertaken by using consistently applied methodologies, arguments, and reasons on industry risk, credit matrix, debt matrix, and so on. This is a challenge for us to train analysts to do this consistently, to identify factors, make reasonable assumptions, provide benchmarks for rating actions, and then communicating to investors on a timely basis. That is a challenge that we continue to face. Another factor here is acceptance of negative rating actions. Of course, this is a tough one because of the reluctance of issuers to accept rating downgrades, right? That leads to appeals and counter appeals and justification that things will be on the mend. There are some areas that the rating agency has not looked into, and so on. So there is this dialogue between us and the issuer. So that can, sort of delay the rating action. So the appeals and counter appeals is something that we continue to face whenever there is substantial, sharp negative rating action that needs to be taken. Another factor is timely rating action that needs to be in sync with the industry and business dynamics. We need to eliminate assigning ratings that track events, that's pro-cyclical, and we have to undertake rating actions that are rating through the cycle, right? So for example, now we have very high crude palm oil prices. So does it mean that a company involved in this sector would deserve a high rating? No, because we have seen CPO prices have come down from the highs of 5,000 to 2,000 and so on. So we have to take a broader picture, longer time horizon. So we have to avoid taking short-term rating decisions. We also need to avoid the perception of deferring rating downgrades, that would upset issuers and so on. So this is, again, the investors may have certain perception, and we need to then undertake the right measures to not allow this sort of perception to take root. So fortunately for us, we have, to preserve our objectivity, we have certain built-in mechanism that eliminates those bias, right? Firstly, in terms of the shareholding structure, right? By design, no one entity controls us or can control us. There is a limit on shareholding interest. Our ownership is spread out among 24 shareholders. As you can see on the chart, they consist of entities involved in financial services, many investment banks, insurance companies, stockbroking firms, last but not least, 2 other foreign credit rating agencies, also our shareholders. The second factor is all rating decisions that Mark makes, assigning new ratings, upgrades, downgrades, whatever, are jointly taken with external rating committee members. These are members appointed by the Securities Commission, and they are in the driver's seat. The external committee members do not have any operational or financial link with Mark. The chairman of the rating committee is as an external member. What this does is that they provide check and balances, they provide expertise, and mostly they telegraph to the market, the investment community, that rating actions that Mark has taken have external inputs from reputable individuals. This also highlights that the decisions are unbiased, are objectively made without any one individual having an undue influence. Of course, the third factor is regulatory supervision and the weight of the regulatory oversight. All our rating decisions and activities are monitored very closely by the Securities Commission and the investment community. Anything that's not in sync with expectations, we get called out, we get feedback from the community. So again, that keeps us very grounded in terms of our approach. In terms of how we have fed Mark's rating default statistics here, I've just fleshed this out. Our rating accuracy ratio has steadily increased to about 70% as end 2020. It's an upward trend. There has been absence of severe negative rating rating decisions recent years, no rating cliffs. This points to somewhat to a timely rating actions that we've taken, right? In terms of rating stability, that also has fairly held up. One reason for this is the strong, good composition of the credits. Many of them are in the higher rated AA band. As I mentioned earlier, because of investor aversion for weaker credit profiles, companies or corporates that had access to the debt markets generally had better credit profiles, hence the strong rating stability. Complaints heightened during crisis. We have seen that whenever there is a crisis, the investment community can get very anxious about our rating actions. We saw that in the aftermath of the global financial crisis in 2008, also last year, post-COVID-19 pandemic crisis. They want to know about our next course of rating action on the industry outlooks, the business outlooks, what are the triggers for rating actions, is there anything that the issuers can do to forestall any negative rating migration? Our take has been make it known, right? Engage with the investors and market participants, make all of our views clear. For example, our view on the impact of the crisis on the various sectors, how it may vary on different sectors, how individual corporate credit profiles may play an important role in terms of the rating migrations. We also need to indicate the conditions by which rating actions will be triggered, explain if there are headroom available within the rating bands. The long and short of it, we need to do conference calls periodically with the investment community and interact with the investors with timely reports. This is Mark's rating upgrades, downgrades chart. As you can see from the chart, downgrades and defaults were the highest in 2009 due to the impact from the global financial crisis. In the subsequent years, we had downgrades only peaking in 2012. Post global financial crisis, investor risk aversion for lower rated bonds led to substantial issuance of debt instruments in the AA and the higher rated bonds. And this right now account for about 80% of our total marks issuers. The high rating bands imply stronger credit profiles. They are characterized by diversified earning streams, strong market positions, strong off-takers, support mechanism as part of established corporate groups or from shareholders. Also, they have stricter covenants that are in place for discipline purpose. As a result, the impact from the COVID-19 has remained muted thus far. Finally, as a regulated entity, Mark's main role is to offer objective credit opinions that are based on reason and consistent arguments using tested methodologies. We adhere to that. Rating actions would need to keep pace with the changing business dynamics and operating environment, but without resorting to knee-jerk reactions and decisions. And as Mark's rated issuers are mainly in the higher rating bands, their credit profiles provide buffer to absorb weakening business and financial metrics from the pandemic-induced shutdowns and closures, as well as other crises. We also need to frequently engage with market participants to apprise of Mark's assessment on the impact from accounting, business, industry changes on the rating landscape. Thank you so much.
Okay, thank you, Rajan. And now may I hold on to your questions still. Let me call on our second speaker for this topic, Dr. Sanamba Roy, Chief Rating Officer of Infomerics Valuation and Rating.
Hello,
Dr. Roy, take
Yeah.
over, please.
Mr. Dumla.
Hello.
Hello, am I audible?
Yes, yes, we hear you.
Yeah, thank you. So, good afternoon to everyone. It's a delight to speak at this forum.
Excuse me, Raja, you still have your screen.
Oh, okay. Sorry.
Okay.
Yeah, thank you. So, I'll try to share my screen now and try to speak on this interesting topic on independence and objectivity in while assigning ratings. Yeah. So, the previous speaker, Mr. Rajan, has actually kind of elaborated quite on the issues that we face while assigning ratings in the realm of independence and objectivity. Now, what I wanted to focus is how we ensure independence while assigning ratings. The first thing is the presence of a Chinese wall. There has to be a proper Chinese wall between the business function and the analytical function. It goes without saying that the analytical function has to be completely independent of the business function. Ratings should not be assigned when board members have a pecuniary interest, because then there may be a conflict of interest that comes arise. There are certain constraints where analysts have exposures in companies being rated. If when we get such mandates, we have to ensure that such analysts are kept off from assigning ratings to these kind of companies. The rating agency, especially, we kind of have an independent mindset as equivalent to auditors or regulators. Because this is very important, because as auditors kind of give an independent opinion on the accounting framework, on the accounting policies of the company, we give an independent opinion on the credit evolution of the company that we rate. So that is why as a CRA we need to have an independent mindset. Then this leads to the independent evolution of credit metrics. We shouldn't get biased by, as in India, all CRAs or we Infomerics are accredited by both SEBI and by the Reserve Bank of India. But we shouldn't get biased by the evaluation done by the banks or evaluation done by other market participants. We have to give an independent evolution of the credit metrics. We should also ensure that in case of manufacturing entities, in case of infrastructure entities, plant and site visits should be undertaken. Then there should be regular meeting with the auditors and the lenders of the company. Objectivity. Now, what is rating? Rating is basically an assessment of the probability of default. It should give an early warning to the investors. It should also try to gauge where exactly the company lies in the broad rating scale as stated by the regulator. It should give we should try to give a firm credit opinion without any biasness. By doing so, we should promote transparency to regulators and market participants. There should also be a regular monitoring of the portfolio. Now, that is where we come in. We have to fill the gap between regulator, investors, and issuers. Now, issuers, be it banks, if there are investors, be it banks, be it market participants, they may not have access to information, they may not have access, they may not be able to form a credit opinion, which is a function of the information and the financials of the company. That is where as we as a CRA step in, and we try to fill this gap, and we try to gauge where the company lies in the broad rating scale. While doing so, there are two important that come into my mind is that when we
तो वो 9.84 का टर्म लोन 4-5-6 टर्म लोन में बाइफरकेट किया हुआ है, कोई 2 करोड़, कोई 2 करोड़.
I think there's some noise. Okay, when we give the rating, when we assign the ratings, we should be ahead of the curve. There is always this sword of Damocles hanging over rating agencies, where market participants, where regulators always say that rating agencies have been behind the curve, that we have been slow in downgrading ratings. That shouldn't be happen. This is one of the main challenges, that we have to formulate our systems in such a way that we are ahead of the curve, and there should also be a through the cycle approach. There shouldn't be knee-jerk reaction to one quarter results, or a quarterly earnings inflation or deflation. The ratings should have a through the cycle approach. They should be stable for a 2 to 3 year period. Now, the challenges that we have faced recently, informatics is a very new entrant in this industry. We got our accreditation only in 2017, so it has been a 4-year journey for us. So the first challenge that we have faced is the COVID-19 crisis, and the challenges that we have faced through this crisis is that where issuers come in and tell us that our results have been impacted for 1 or 2 quarters due to the COVID crisis, and they will come back when the crisis abates. But that is where rating agents, we have to be very objective. We need to kind of separate the chaff from the wheat. We need to see whether the dip in results or the blip on the radar has happened only due to the COVID crisis, or is it due to some underlying business problems. So this is where the through the cycle approach and being ahead of the curve comes into play. So these are the main challenges that we have faced while being objective in assigning ratings. Other than that, we have been able to take care of by many ways. We have an external rating committee that ensures that the ratings that are assigned are fully independent in nature. Our rating team is completely divested from the business team. That ensures that the analytical note or the analysis that is done is completely bereft of business objectives. So these are some of the steps that we have taken while assigning ratings. So this is the short presentation that I have made for today. Thank you, and the house is now open, I think.
Thank you very much, Dr. Roy. Now we shall open the floor to questions. I saw one question already there. Let me see, who was that? Noor? Mr. Noor or Miss Noor? Are you there?
Yes, sir.
Do you have a question?
Yes, my question is, can you hear me?
Yes.
My question is, sometimes, like in our country, there are some major news in the newspaper or from public information, but that we don't have any further information for the clients or for the Securities Exchange Commission or anywhere. But the information is major, which may lead to downgrade the companies. So what other rating agency do in that case when these informations are not supported by any documents or any or what do they with the due diligence of to downgrade the ratings, or what?
Okay. Who would you like to answer that? Dr. Roy?
Yeah. See, if there is what we feel is that if there is your question actually comes on the articles that come from newspaper and all, but that has to be corroborated through a talk with the issuer, because many a times newspaper articles are kind of jump onto a bandwagon or jump onto some issues. So that have to be corroborated through the talking with the client, with the issuer, and trying to understand whether it has really happened, what are the underlying dynamics behind it, and then we should take a rating action.
Do you want to have an answer to that, Rajan?
Yeah, I think rating actions are, a very, very serious matter. So when you take a rating decision to downgrade or even to upgrade, it must be based on verifiable data and facts with thorough interaction with the client, fully understanding. So it cannot be a rumor based or some newspaper article that tells, so it could be a vested interest. So we have to verify and we have to be fully ascertain. And as mentioned in my presentation, the rating decision that we have to take, it has to go through a committee. committee consists of external members. They need to be convinced that we are on the right path in terms of the information, the data we are providing for them to come on board with the rating decision. So it cannot be just taken on hearsay or rumors, or we get that with the social media. So many things happens all the time. So we don't give much weight to that until we can verify. Of course, if it's a trigger for us, then we'll investigate thoroughly. And when we take a rating decision, it cannot be revised the day after, or you just say, oh, apologies, you just cannot do that. So it affects our reputation. So the whole process is set up such a way that it has to go through a very stringent criteria to take on a rating decision.
Okay, I hope that answers your question. We have another question from Mr. Balkrishna. Would you like to ask the question yourself, please? Mr. Balkrishna, are you there? Or let me ask the question. How do you ensure in all rated instruments timely rating actions during counter-cyclical phase and systemic risks facing the economy? That's the question. I will repeat. How do you ensure in all rated instruments timely rating actions during counter-cyclical phase and systemic risks facing the economy?
Yeah, I would like.
Yes, go ahead, Dr. Wright.
Yeah. See, there are two things. One is that when I spoke in my presentation is that ratings should be through the cycle, should have a through the cycle approach. When we compute our PD, or when we compute our transition matrices, or even our probability of defaults and all, there should be stability for at least a 2 to 3 year period. So as an agency, we should be able to, through our own research team, through our own economics team, we should be able to forecast counter-cyclical periods. Though I know it is difficult, but we should try to forecast counter-cyclical periods, and that should reflect in the rating when it is assigned beforehand. Now, there is one point. There are sometimes external shocks that happen, which is not forecastable, such as the COVID-19 crisis. Now, when such shocks happen, we should be able to distinguish whether the blip in the radar has happened due to this crisis or due to some underlying business constraint. If there is so that has to be presented to the committee, and the committee then should take an informed call as to whether the rating should be downgraded or upgraded based on this blip, which has happened due to the external shock, or due to the underlying business, or due to changes in underlying business dynamics. Thank you.
Rajan?
Yeah, I just agree with what Roy said. Just to add on to that, of course, within certain sectors and so on, the corporate credit strength can differ. Some of them are stronger. Some have got liquidity that can sustain, the systemic risk that you mentioned. So we will, of course, analyze on a case-by-case basis and to see whether they can withstand this shocks. Again, when we assign a rating, we tend to look in a different horizon. We do sensitivity analysis, worst case scenarios and so on. So when we give a rating, it is supposed to be resilient over a period of time. So if there are factors that are affecting the credit health of this entity, then we have to do a thorough investigation and also do a post-mortem and see why did we not see this happening, so on. So again, it is on a case-by-case basis. By and large, companies in certain sectors would have different characteristics. We also take that into consideration when we take any decision.
Are there any comments from other members, participants on the same question? Well, it's always really an issue. It's a challenge for us, but we try our best. Okay, any other questions? If none, let's move on to the third topic, and after we listen to two more speakers, and after that we'll have an open forum on anything and everything. Okay. The next topic we are going to address is the application of consistency in ratings. Well, consistency can mean several things. It's consistency within the organization in the application of your published methodologies. Consistency in their application by different analysts in different industries. There's also consistency between the ratings of rating agencies within the same jurisdiction. And can they be so different? And if they are so different, there must be a problem somewhere. And there is also the consistency with the rating of global rating agencies who happen to assign ratings within your jurisdiction. So these are the main areas for seeking consistency. But let me not go ahead of our speakers. May I now call on Mr. Sakin Gupta, Chief Rating Officer of CROs Ratings Limited of India, to make his presentation. Welcome, Sakin.
Great.
Take over,
Yeah, thank you, Mr. Damlao. Great. Thanks. Thanks for this opportunity. I'm Sachin Gupta at CROs Ratings. Just as a matter of quick introduction, I've joined CROs Ratings as the CRO very recently, just about 7-8 months back. Before this, I used to work with CRISIL Ratings, another leading rating agency of India. And there I had roughly about 17 to 18 years of experience. And now I'm kind of here. Mr. Dimlao had set up the context very well. So since we are in the business, all of us are in the business of ratings. It's very critical to see how consistent the ratings are. And yes, they are different in some ways. The most obvious one is the difference in the global ratings versus the domestic ratings for a particular country. All of us are from various jurisdictions, and therefore we have different rating scales. And then we have global rating agencies like S&P and Moody's, and who have kind of global rating scales. So those differences are quite obvious. So I will not be really covering in terms of how, because those are clearly different products for different markets. So those by definition cannot be consistent. Say a global ratings versus a domestic rating. Domestic ratings obviously are relevant for that particular geography, and in that same sovereign, where typically the sovereigns are rated AAA, and from there downwards. So that's just as a matter of background. Now, if I were to really see, why exactly the ratings need to be consistent, that's very important. Just to give a context, in India, for example, almost all the regulators, all the investors, all the lenders today look for external ratings while making their credit decisions. So in terms of the importance of ratings per se, it's very, very high. I would not be exaggerating to say that any credit decision, even I would say even as small as a $2 to $3 million kind of a size, today requires an external rating, especially because after the implementation of Basel II norms. So at the basic concept, the ratings are very critical, and because ratings are so critical, the consistency amongst them becomes very important as well. So here on this slide, I'm kind of trying to show, from three different perspectives, why it is so critical. First is investors, so they obviously are relying on the ratings to price the risk. And when they price the risk, if a rating, say a rating A by a certain agency, and then a rating A by another rating agency, if they are different and not really demonstrating exactly the same risk or nearly the same risk, then there is a problem. So therefore, it's very important to be consistent. Even within a rating agency, say a paper which is, say, a finance company paper versus a toll road project paper versus a steel company project debt paper, they also have to be consistent. So, the importance of, because at the end of the day, the investors or the lenders have to price the risk. So therefore, I think that's the very premise of having ratings, that at the end of the day, the ratings allow the lenders and the investors to really look at all the credits as at the common denominator. So therefore, the importance of consistency in ratings cannot be, to my mind, overstated. It's extremely important. The whole basis of ratings is being consistent. Similarly, if I look at regulators, regulators today in India and across the globe, they price, say for a bank, when they calculate the amount of capital which is needed for the bank, and when they risk weight the assets, which is basically the loans, it's done basis the ratings there. So, the entire financial system per se is kind of looking at ratings to really calibrate the amount of capital required. And since they would be treating all the ratings same, so there are, say, 3 or 4 rating agencies in a particular market, and all the ratings are kind of taken equal to each other. So therefore, the consistency in ratings across the multiple rating agencies and within the rating agencies becomes very critical. So it's extremely important, therefore, to have importance, because if it is inconsistent, then we are actually exposing the overall financial system to a high risk. And therefore, the development and stability of the financial markets kind of, in a way, is predicated on this. And finally, from an issuer's perspective, they obviously, and it's a meeting of minds of the issuer and the investor. So again, it comes back to the pricing bit. At the end of the day, the rating will kind of help you get the right price. And therefore, if the ratings are not consistent, that whole use of the ratings to kind of arrive at the price of the debt, the interest rate, the coupon amongst the investor and the issuer could be, may not be reached. So therefore, I know these are all very, very basic things, but just to set the context for the presentation, it's, I'm just kind of trying to highlight, how important the consistency in ratings is. Moving to the next slide, what we are really saying is that while, yes, the consistency in ratings is extremely important, the next question is, what are the challenges that we are facing, in maintaining rating consistency? And just to give a context, and more from an Indian context, in India, there are more than 20,000 companies which are rated today. CARE Ratings itself has nearly 5,000 companies or so rated. So really making sure, and then, it's across multiple analysts, multiple teams, multiple geographies. It's obviously, and it's not a kind of a model-driven ratings, right? They're not really a black box, punch in the number. There is a fair bit of subjectivity involved. So yes, it is important to, it is a big challenge to maintain the rating consistency. Some of the points that I've kind of highlighted on the screen, one is the rating teams are different. That's at the most basic level. There is a bias which kind of comes in just by having a different person, the same person looking at different companies, or the same company at may be different. So therefore, that's the basic thing, where the different people are really assigning the rating. So that can bring in challenges in maintaining the rating consistency. The second point is different geographies. For example, in CARE, we have nearly 10 offices across the country. And while, yes, there are, models and practices and, processes which are there to standardize it, but still the fact that they are in different geographies can bring in challenges in maintaining consistency. The third point is, I would say, one of the most critical one here is in terms of different asset classes or sectors. How do I make sure that a triple B rating assigned to a finance company has exactly the same default risk or the probability of default as a triple B assigned to a road project or versus a steel company? Now, because you may be extremely consistent within a particular sector, that's because you can look at the risks and then you can rank order them, or kind of assign probabilities of default, and therefore you may be more confident about, say, 20 banks that you rate, and then say, my best bank is rated AAA and my weaker bank is rated triple B and all that. So that's easy. But when I have to compare across sectors, it becomes more challenging, and which at times we do get to see from market. For example, in India, just to give an example, there was a challenge that the NBFCs, which is basically the non-bank financing companies, they were facing some challenges in liquidity. The ratings there were still high, at single A, double A, because at the basic level, the risk was not so high, and therefore the ratings were, maybe downgraded 1 or 2 notches, but they're still in high rating categories of, say, single A and double A. But when we looked at the yields at which those bonds were trading in the market, there was a sharp difference. They were maybe trading more at a triple B kind of a level. So there, those questions do arise that, is your AA assigned to a particular finance company, same as AA assigned to a government-owned a public sector bank, because the market is looking at them very differently, even though on numbers, on business outlook, they may be, not having very different probability of default. So that's something I would say, the different asset classes and sectors, that's I would say is one of the big challenges for maintaining consistency. The other point, level of expertise. Again, these are more specific to a team or to analyst level that can kind of bring in challenges. And the last one is, different rating committees. We've seen at times the rating decisions get taken by a rating committee. I know it should be avoided, but then there are these biases which do come in because of maybe some rating committee member being either over optimistic or over pessimistic, and therefore, leading to different rating outcomes. So, on this slide, I've kind of tried to cover which are the top reasons, why the maintaining the rating consistency remains a challenge. The next point, again, continuing with the challenges, and I've picked up just as again as an example, is specific to a risk, which we think is in some ways most challenging in terms of maintaining consistency, largely because it's highly subjective. And that is the management risk assessment. So while on the financial side, you can rely on numbers, on the business risk, again, you can rely on various parameters, operating parameters, cost efficiencies, on market share, things like that, distribution network, etc., which are more and more quantitative. But when we look at management risk assessment, that is one aspect where we feel within the overall rating framework, there is a fair bit of subjectivity, and therefore the maintaining the consistency is at times is a challenge, and especially when we're talking about assessment of integrity, about the ability, the risk-taking ability of the promoters and the management, or what is their competence. So those again can have sharp differences because they are more and more subjective. Again, I will come to as to how we really manage this, because this is obviously a challenge. But how do we kind of, so in next slide, we will cover the issues in terms of the how exactly at CARE Ratings we are looking to enforce consistency, because as I said, consistency is really the bedrock of any rating company, and in that context, it's extremely critical that we kind of work on that. So, and over the years, I would say these things have been kind of fine-tuned. The first thing that I have on this slide is the multi-layered rating process. So as we discussed earlier, there is a challenge in terms of a different team, a different geography, different analyst, bringing in some bit of a challenge and consistency. So what we do is that is a multi-layered thing. So there is a team of 2 analysts who does the primary analysis. Then we have their superior, the group head, who will have a much larger portfolio, and then the rating head. So it's a 3-level process which kind of ensures that any individual biases are kind of taken care of. And on top of that, we have the rating committee. So having a multi-layered process ensures that to a large extent some of those individual biases, because the biases lead to discussion, and then you threadbare discuss what really are the issues which are causing those differences, and therefore a consensus can be reached post that. The second point, where what we really have been doing at CARE is making the criteria and models more and more objective. While there is a subjectivity in the rating process, it's about predicting future, and when you predict future, there always needs to be subjectivity in it, because you cannot really objectify how the future will unfold. But still, to cover that challenge, at CARE Ratings, we do look at criteria which are more and more objective. Just to give a simple example, say a renewable energy project with, say, a certain counterparty, we try and objectify it by saying, okay, fine, if the DSCR is 1.3, it should map to so and so rating. If the DSCR is 1.5, it should map to so and so rating. Now that is a good starting point. It may not always mean that you just look at one number and give a rating, but we try and have at least the basics starting with a number, and then you can have the rating higher or lower depending on, say, for example, the strength of the counterparty, the track record of the promoter, the technology which the developer is using, the track record of the technology which they're using. So the point is, at some level, having more and more objective parameters, and which is what we try and do in our criterias, in our model, have more and more objectivity numbers, which so that the biases, the individual biases, are kind of taken out of it, and everyone is and when before arriving at these objective parameters, there is obviously a full in-depth discussion amongst the people, and also looking at the market, also taking feedback from the other market participants like lenders, etc. So have models which are more objective, and then kind of implementing those models in a very objective manner. The third point here I have is, again, if you have all these models and criteria, we need to regularly train analytical staff. I don't know about other rating agencies, but in CARE and in the Indian rating industry, there is a fair bit of turnover. The fintech industry is doing well. The banks are also doing well. So there is always a demand for good analysts from rating agencies going and moving on. So we always have, say, 20-30% of the team which is fairly fresh. So training them and getting them up to speed with the existing models, existing criteria, processes on an ongoing basis is very, very important for us to kind of make sure that the consistency across the ratings is maintained. The fourth thing here, which CARE has been kind of taking lead in doing in the last few years, is having sector specialization. Now, what at times can happen is that you're looking at, say, a particular company in a particular geography, and there are different teams operating out of different geographies. But what we try and do to at least maintain consistency within a particular sector is that have one team which is looking at all the companies in that particular sector. So instead of having a geographical arrangement, you have a national teams which are looking at all the companies of a particular sector. So say steel companies, I may be rating say 50 steel companies across the country. So they will be a team of, say, 5 to 7 analysts. Between them, they will be rating all the steel companies. So they are able to kind of calibrate it much better, and the quality of analysis is much better. They are able to address issues in a faster way, understand what's happening at the global level, domestic level, and take timely rating actions and more consistent rating actions. So that is something which has yielded good results for CARE. From a quality control and from a on account of sector specialization. The other thing, which again is very, very critical, is doing inter-firm comparison. So what happens is that as one particular agency, I may be rating, say, 10 companies in a particular sector, but there may be another 20 companies which I'm not rating, but they have outstanding ratings there. And those numbers a lot of times are also available because they are being listed or they anyways declare their financials. So when we do assign a rating, we also look at as an inter-firm comparison, whether the rating that I'm assigning to a particular company, both on financial and business parameters, is it stacking up right? So that, in fact, the whole premise of doing an inter-firm comparison is to make sure that our ratings are more and more consistent, not only of the entities rated by one rating agencies, but going outside the rating agencies and looking at all the companies in that particular sector rated by other agencies also. So that I would say over the last many years has kind of made the ratings much more consistent. The other thing we also do is market intelligence, and this is again a little softer aspect. A lot of times the companies do report good numbers, but they may be some suspicion in terms of whether the numbers can be trusted, whether the projections that the company is giving are easily trusted, or what has been the track record, what do bankers feel about it, what do investors feel about. So doing a bit of a 360-degree discussion, not only talking to the issuer but also having a dialogue with the other stakeholders for that particular company. Maybe it could be its peers, maybe it could be having its vendors, suppliers, customers, that kind of gives a good perspective. And this needs to be done, especially when we are looking at highly rated corporates, single A, double A kind of credit. It's very, very critical to maintain the consistency. And finally, on the rating committee side, we believe that, so at times we used to have something called sectorally specialized committees, or geographically specialized committees. We've done away with that, and we are making it more and more senior and across the sectors. So the rating committee would have members which will be, from finance, from infrastructure, from corporate, which again brings in, the whole idea there is to bring in consistency, because then someone who's specializing in NBFCs or say a housing finance companies can relate that, whether a rating being given to a cement company, a rating of A, at a very basic probability of default perspective, is it aligned with, say, the other ratings that we have? So having a senior committee which and diverse across the various sectors allows us to bring in consistencies. So these were some of the things that and this is, I would say, a learning of the last 3-4 years, how as the markets are getting more demanding, we are kind of making it, and ratings are becoming more and more central to the overall credit decisions across the financial markets in the country. We are working towards making them more and more consistent. So that's it. That's it. Brief presentation from my side. Thank you.
Thank you, Sakin, Mr. Gupta. You have brought out several touch points which really stimulate more questions. But let's hold on to our questions and listen to our next and last speaker on the same topic, Mud Asiful Haq, Chief Rating Officer of CRISIL of Bangladesh, on the application of consistency in rating, the same topic. And after that, we have an open forum for everything and anything covered. Take over, please, Mr. Haq.
Thank you, Mr. Dumla, Honorable Chair of this session. Thank you, ACRAA, for taking such an initiative to update our knowledge on various issues of rating, and of course of today's topic on the application of consistency in rating. Distinguished participants of the ACRAA member credit rating agencies, it's my privilege and an honor to present and share Bangladesh updates on application of consistency in
You
rating.
can show your face. We don't see your face.
Okay. Sorry. Thank you.
Okay.
Can you see my presentation?
Yes. Thank you.
So, assalamu alaikum and a very good afternoon to all of you. Actually, my presentation is a very big, but I think I have to shorten my presentation. I want to concentrate my presentation on these areas. This is the presentation summary. First, I want to cover the rating context and overview in Bangladesh, and then need of consistency in rating. After that, regulation, methodology, and consistency in rating. And after that, as you have already said, consistency in rating within the rating agency, consistency in rating among the rating agency within the same jurisdiction, and consistency in rating among regional rating agencies, and last, consistency in rating within the global rating agencies. Before I go to the detailed discussion on the consistency issues, let me tell you about briefly about the current practice in Bangladesh market. Actually, in Bangladesh, rating was very much limited, primarily with the issuance of debt and public issue of share at right premium. Later on, bank and insurance rating became mandatory. But issues of rating got the momentum in Bangladesh in 2009 when Bangladesh Bank decided implementation of Basel II, and it gave recognition to CRISIL and other local external credit assessment institutions to conduct credit rating for banks' corporate exposure. And after that, when Bangladesh Bank introduced Basel III in 2014, and when it brought the bank's claims on SME exposure under variable risk weight, it got further momentum in Bangladesh. And now banks' exposure on SME are under the purview of credit rating, and in all the SMEs in Bangladesh are supposed to be rated to calculate the bank's capital requirement under for credit risk under a standardized approach. And right now we are doing rating about 8,000 rating, and maximum rating is coming from the SME sectors. About 80% we do the SME rating, and rest 20% our bank, financial institutions, corporates, and other debt instruments. So we have a large number of SME rating right now here in Bangladesh, and definitely consistency in rating is a very big concern to us. And we put utmost importance and update our rating methodology in line with the changes of macroeconomic fundamentals as well as the sector-specific issues, and disseminate and share the related information among the relevant analysts to avoid and minimize the inconsistency in rating that we perform. Now, this is the current rating areas in Bangladesh that I think it doesn't need to be discussed. Now we have a consistent rating growth in Bangladesh market from 2013 to 2019, except into 2020 due to COVID-19 pandemic issues. It has already said our market is majorly driven by the SME sectors. 70 to 80% rating are covered from SME, and 20% is coming from other sectors. Now, why the consistency in rating required? It is to facilitate the cross-border transactions and issue pricing, as well as the enhanced rating franchise value and movement of customers from one rating agency to another rating agency, and acceptability of rating reports by the investors to revise their strategy and enhance the reliability of rating, as well as it's a regulatory desire to have consistency among all the rating agencies for better comparability. Now, regarding the cross-border transaction, to reap the benefit of cross-border trade, the growing interdependence between the worldwide economies had increased corporate transactions, and companies need to acquire enough critical mass to be able to compete against global players. In every cross-border transactions, cross-border payment, banks and a group of varying domestic entities work together to transfer funds, and one of the most critical decisions that the parties to a cross-border transaction will make is the choice of governing laws applicable to the deal. So definitely entities involved in the transactions require rating, and there should be consistency in rating among the different CRAs of different jurisdictions to facilitate the cross-border transactions, especially tax payment issues, governing laws of different jurisdictions, etc. Consistency of rating for issue pricing in case of public issue of shares, rights of offer, repeat IPO, issuance of debt securities, as well as for any other securitization transactions, and as well as for issuance of sukuk. Securities need to be rated either on a compulsory regulatory requirement in different jurisdictions or optional basis. Investors and bidders need issue rating as well as of issuer for participating in the bidding process of issue pricing, and hence consistency in rating among CRAs should be there for same issue rating by different CRAs under same jurisdictions or different jurisdictions. Acceptability of rating by the investors. Investors need a comparable and consistent rating for better and informed rating decision. They want to rely on rating reports in devising their strategy and best possible investment decision, for which consistency is required. And another thing why we should have a consistency in rating is the regulatory desire. Regulators of different jurisdictions also do require and desire consistency in ratings among different CRAs within the same jurisdiction or different jurisdictions, as they have to accord approval before issuance of any debt securities or IPO or rights offer. And moreover, to assess the performance of the different credit rating agency as well as required by the CRC rules, and as well as requirement of performance evaluation of external credit assessment institution in line with the Basel Capital Accord. Regulators need consistency in ratings aspect. Now, why the inconsistency actually arises in the same jurisdiction or different jurisdictions? I have tried to find out some causes why disproportion arises. In line with the CRC regulation in Bangladesh, all the credit rating agencies in the country are supposed to disclose and update rating methodology, and they are supposed to review and update the rating quarterly or semi-annually as per the BSEC regulations. But rating methodology they do follow for various sectors or economic segments such as bank, financial institutions, sometimes differ from one CRA to another CRA. Though because central bank in its early stage of recognition of CRA as eligible CRI set some broad risk factors along with scoring range for bank and FI and corporate as a whole. I don't know whether in some other jurisdictions regulator has such intervention of considering risk factors as well as scoring a range in the to go for the rating decision finally. I don't know whether, but in Bangladesh we have the regulatory broad guidelines that is for bank or financial institutions or corporate rating. They have set some broad factors to be followed by the different CRAs. Hence, rating factors of individual CRA along with the scoring system are harmonized with the Bangladesh Bank standard scoring system. There is distinction among CRAs in methodology formulation and its application by analysts of different rating agencies for fair, independent, and objective and credible assessment. Non-conformity and disproportion arises regarding the application of the methodology, and I think due to this inconsistency in that methodology and different risk factors followed by the different rating agencies in a different way, as well as the risk weightage they put for different risk factors, there is dissimilarity in the risk weightage, and again non-conformity in the application of the methodology by the different analysts in the same rating agency as well as in other rating agency. All this together contribute for the inconsistency in rating. And let me explain it in a more way. That is, for example, in case of bank or financial institutions rating, CRISIL put more emphasis on the consolidated operation of bank and financial institutions, along with its investment in the associate company, in line with the IFRS 10 and 12, other than the core banking operation of the parent itself. Because banking sector regulator has allowed banks investment in the brokerage house operation, merchant bank, asset management company, and exchange house operation, and mobile financial services, and made it mandatory to form separate company for such investment. Now, while reviewing the methodology, maybe another CRA or some other CRAs within the same jurisdiction, they only consider the bank's own operation rather than the investment of their quality of investment and return from subsidiary operation or associate operation. So some rating agencies they put emphasis on only the core banking operation, and other rating agency they put emphasis on the consolidated operation, that is other than the core banking operation. They put emphasis on their investment doing, that is asset management operation or merchant bank or brokerage house operation, or even the mobile financial service or exchange operation. That is in whichever whatever venture they do have the exposure, these are reviewed and considered. Again, in the application, one CRA, one crediting agency put more emphasis on the profitability or liquidity factors and fundamentals of operating efficiency, while other CRAs they may put weightage and more emphasis on the capital adequacy or asset quality or risk management practice. And some CRAs only consider the pillar 1 risk, that is only the credit, market, and operational risk, while the other CRAs may consider not only the pillar 1 risk, they may consider the pillar 2 risk in line with the Basel 2 and 3. Again, one rating agency they consider the tier 1 capital, while the other rating agency consider both the tier 1 and tier 2 capital. Regarding the asset quality of a bank, one rating agency they may consider just only the disclosed non-performing loan, while the another rating agency they do consider the recognized NPL as well as the stress asset position and as well as the large loan concentration for which actually inconsistency in ratings may arise. Again, regarding the evaluation of credit risk management, one credit agency may rely merely on regulatory reporting, while other rating agency gives more emphasis both on regulatory reporting as well as the physical verification of the documentation of the borrowers or CRM notes or subsequent loan documentation, for which bank may warrant more loan classification as well as the loan loss provision, and which will directly impact the bank's credit quality as well as the profitability and liquidity. So another thing is that sometimes there is regulatory intervention through policy support or realization or intervention of the legal system. This may create adverse impact on the bank's asset quality. So consideration of all these factors sometimes warrant a rating adjustment, and if they don't consider in the same way, then it may tend to inconsistency in rating from one rating agency to another rating agency. And while looking at all these factors for its incorporation in methodology and its due cognizance in the rating analysis of those scenario may create inconsistency in the rating among CRAs in the same jurisdictions. Now, do you say why the consistency arises? Let me discuss in such a manner. Consistency within the rating agency first. As I've already told, within the rating agency, why there is inconsistency in the rating. Suppose in Bangladesh, CRAs in line with the regulatory broad guideline follows common SME methodology for all types of SME business. But in practice, SME has more than 100 subsectors for which CRA doesn't have separate methodology. And for example, one SME is involved, suppose selling of SME a SIM card of mobile phone operator, while another one is in the trading of the raw cement or the pharmaceuticals product, or another SME runs a semi-auto or auto rice mill. So due to inherent business nature, risks involved in the trading and manufacturing operations of SME business are not the same, and magnitude of risk in the different SME business vary, and for which inconsistency may arise in the application of the same methodology equally. Another problem is that for which inconsistency may arise in the rating, because difficult is for accounting records and its disclosure. So in this region, audited accounts of both corporate and SME are yet to reach at a standard and reliable level, and because of some accounts are prepared for tax purposes, some are with the objective to mobilize funds from the banks or financial institutions, and hence application of rating methodology based on audited accounts sometimes doesn't truly reflect the entity's credit worthiness. So for these reasons, inconsistency may arise due to the methodology difference, as well as for the application of the audited accounts or the management accounts in their rating analysis. And now inconsistency may arise among the rating agencies. Regulatory desire is different CRA should follow common methodology and there should be consistency in rating. But thing is that in rating, actually consistency or inconsistency may arise among the rating agencies of different jurisdictions and region, and this may happen due to inconsistent methodology among the rating agencies. Though methodology of different CRAs of a particular industry are approved by the regulators, it may differ in terms of considering different risk factors and its ways of analysis and importance of weightage on a particular risk in its rating model. Suppose in Bangladesh, while recognizing ECI, External Credit Assessment Institution, our central bank has set some broad risk factors for both for corporate rating and as well as for the bank and financial institution rating. But the same risks are not equally applicable for. But thing is that here deviations in the industry specific parameters and subsequent weightage by the different CRAs in its analytical framework may create inconsistency rating among rating agencies, because I don't know whether in some other jurisdictions in Asia, in Pakistan or in India, whether regulator has such kind of regulatory embargo, or they have any guideline for considering the risk factors in the rating model, as well as the scoring system regarding the rating process. And another thing is that for which the inconsistency may arise among the rating agencies of different jurisdictions, that is the application approach with respect to information. Different CRAs use asymmetric information in quantitative part of its analytical framework. For example, some CRAs put emphasis merely on audited accounts with while another CRAs they consider the management accounts. When audited accounts sometimes contradicts with the management data, and many material informations are not disclosed and covered in the audited accounts, and it cannot be justified, and that's why it cannot be justified, and information flow has to be cross-checked from the bank statement and the sales book records. And hence, due to variation of information requirement and its way of analysis creates inconsistency in rating among rating agencies. Physical verification for which inconsistency may arise among the rating agencies within the same jurisdictions. Sometimes importance of site visit of infrastructure and or business area create impact on the rating analysis and framework. One CRA may put more emphasis or weight on site visit to understand the exact and current business scenario over there, while the another CRAs they merely depend on the provided data and rarely conduct visit of physical infrastructure. Even though expertise of the analyst of different CRAs in case of site visit make difference in analyzing the risk aspects of that business and understanding the competitive advantage and forming the opinion which altogether creates disproportion regarding the application of methodology and ultimately in turn creates inconsistency among the rating agencies within the same jurisdictions. Now, inconsistency among regional rating agency, it is due to regulatory jurisdictions. Due to different regulatory jurisdictions, inconsistency in rating may arise among regional rating agencies. Right now, no rating agency of Asian region or Asia Pacific region practice in Bangladesh. On the other hand, no rating agency of Bangladesh, don't have any direct presence in other rating jurisdictions. In Bangladesh, rating agencies are to follow broad regulatory guidelines. As I have already told, they have to follow some broad guidelines and consideration of risk factors and scoring skill in the rating model, which to some extent influence the rating decisions of the CRs in Bangladesh, and for which inconsistency may arise among the regional rating agencies. In absence of, I don't know whether it is available in other jurisdictions, in absence of such regulatory binding or guidelines, inconsistency may arise from one jurisdiction to another jurisdictions. Another thing, inconsistency may arise due to audited accounts in Bangladesh, as audited accounts are yet to arrive at satisfactory level. CRAs in Bangladesh have to consider sometimes management accounts in its rating analysis analytical framework, while CRAs in other jurisdictions mainly, I think, rely on the audited accounts in their quantitative analysis in their rating model. Another thing is policy implications for which inconsistency may arise among the regional rating agencies, that is the fiscal and monetary policy, trade and investment policy, and as well as the foreign exchange and other government policy related to the economy vary from one jurisdiction to another. Suppose in Bangladesh market, the government has decided or it has encouraged the undisclosed money to invest in the real estate sector or in the capital market to boost the investment, as well as the government in monetary policy, central bank has put cap on the lending rate. Another thing is that to encourage more investment in the power sector, there is a tax holiday, and the government has some support or incentives regarding investment in the economic zone. So these are the policy impacts that have the direct impact on the credit rating and its process, and it may vary from one jurisdiction to another. So all this together, due to consideration of these factors, rating may that inconsistency may arise from one jurisdiction to another. Now, why inconsistency arises with local rating agency from global rating agency? In Bangladesh, international rating agencies like S&P, Moody, and Fitch are involved in the sovereign rating. And apart from the sovereign rating, Moody's in Bangladesh performs a few banks rating in Bangladesh. And in maximum cases, While assigning the rating of local financial institutions, both S&P and Moody's, they highly consider the sovereign or country risk, including the other risk factors of the local bank. In maximum cases, both the rating agencies, they generally assign to local bank one or two notch lower than the sovereign rating, or at best keep it in parallel with the sovereign rating, which is WB minus for Bangladesh. Whereas local rating agency generally doesn't put that much weightage on the sovereign risk in its analytical framework of bank rating, for which inconsistency may arise with local rating agency and international rating agency. Another thing for which inconsistency may arise with local rating agency with international rating agency, that is due to methodology difference. Rating factors considered in the different methodology followed by S&P and Moody, or which may vary to some extent from factors and its weight followed by the local rating agency. So the factors as well as the weightage is a big consideration in the rating methodology, and for which inconsistency may arise with the local rating agency with international rating agency. And another reason for which inconsistency may arise due to on-site review. International rating agency they generally focus more on off-site review and analysis based on the data supplied by the issuer or the entity. Rated entity, whereas the domestic rating agency they lays more emphasis on the on-site review. They physically go, they physically conduct the visit. They see how the business is being run over there, and what is the business prospects in that area. So physical visit is conducted by the local rating agency, and that's why for the for on-site and off-site review. Due to a variation of on-site and off-site review, inconsistency may arise from local rating agencies with international rating agency. In short, this is my presentation, and if anyone have any questions, they are most welcome. You may also share your ideas and your practice in your own jurisdictions through email. Thank you. Thank you, sir. Sir, I think you have to unmute sir yourself, sir. Mr. Dumlao.
Yeah, Mr. Santi, you're muted.
Yes, thank you, Mayor Asiful. Mr. Masurap, you can start asking your two questions. Masuda-san.
Okay, thank you very much for very comprehensive and presentations. And we are facing, to some extent, the same problem, same issues. So it's quite insightful to sharing to your experience. And the first question is maybe we have to learn from actual cases defaults, and without knowing default cases, and the analyst cannot be kind of. Maybe chief rating officer is in position to control over this sort of quality of rating, the credit rating. But meanwhile, now we two issues here. The number of the default is limited right now, and also that there is some sort of confidentiality issue is related. So how do you share of actual lessons which you learn from a default? That is the question number one. And the question number two is for securing the consistency among the rating. You mentioned about the various dimensions of consistency among the agencies, among the sectors, among the countries. But what systematic mechanism to ensure this the consistency? Do you have any periodic review? What mechanism do you set up in your agency to ensure of those consistency? Can you share the organizational aspects of those systematic review? So those two questions to anybody. Thank you.
Well, perhaps Asiful and Sakin can give answers.
Yeah, so I will attempt to answer the second question. Actually, first question I didn't understand properly. So on the second question, in terms of the systematic or the processes that we have to maintain consistency, two things, which very critically allow us to do that. One is what I mentioned in my presentation also, is the inter-firm comparison, which is basically ratings, outstanding ratings for all the companies in a particular sector, which are rated either by the agency, by us, or by even other rating agencies in the same jurisdiction, and then see whether, on the same page you see, how the business is in terms of size, operating profitability, in terms of and then moving to financials in terms of leverage, etc. And then it allows you to compare and contrast and see that whether the rating you are assigning to a given company
Okay.
is in line with the rest of the. Second thing that we do, again, to remove the bias actually from first principles, is to do a portfolio level approach. So what we do is that, instead of rating companies one by one, one company you rate in January and the other comes in March, and then other, we try, and especially on the surveillance side, because initial ratings can happen anytime where they're looking at new bond issue or new debt raise. But when we look at the surveillance, the annual surveillance, we try, while it's not always possible, but we make an attempt to look at the entire portfolio of a given sector set of companies together. That allows us again to do a better comparing and contrasting and ensure that the ratings are consistent within a given sector that is there in my portfolio. The other thing, so this is within the portfolio of the same sector. Now, for the other thing, which is, as I said earlier, is a more complicated thing, and it's a little difficult to kind of do the a bit more system thing. That at the end of the day is the responsibility, I would say, of the rating committee, which has people from diverse background, including multiple various sectors that we have, say infrastructure or financials and corporate and government-owned companies and all that, banks, etc., to make sure that at the basic probability of default level, whether a rating given to a given company is making sense irrespective of what sector it belongs to. So one is within the sector we look at, and that is what we achieve by portfolio analysis and inter-firm comparison. And across the sectors comparison is which is the I would say a more difficult one. That is really up to the rating committee. So I wouldn't say there's any specific practice done or a very systematic process, but it's more of a objective laid out for the rating committee. And the third thing, which is in some ways a look back, what we do is also compare the yields, especially for the entities whose bonds are traded in the public market, and compare the yields at which the secondary bonds are being traded to what they ideally should be for the rating that the company enjoys. So if the company is, say, rated AA, and the bonds are, we give a range that typically, say, a AA rated coupon should be, say, 7.8%, or say a range of 7.5 to 8%. Then if that entity's rating, if that entity's bond yields are going out of that range, that also is highlighted to the analyst to see if he needs to take corrective action. It obviously cannot lead every time the yield goes lower or higher, because there is a market angle there. But at least if any entity is consistently out of range of the bond yields, what it should be given the outstanding rating, then the case needs to be necessarily reviewed. So these are the 2 or 3 things that we do to ensure consistency within the sector and then outside the sector and within the overall portfolio of our rating agency.
Asifo, you want to answer
So
that?
in Bangladesh, to bring consistency within the rating agency, it's a regulatory compulsion also to update our methodology and review the methodology. And we have to review the rating in case of a bond. We have to review the rating quarterly. And in case of entity rating, we have to review the ratings semi-annually. To bring consistency within the rating agency, we always try to update the methodology. We always try to bring the factors that is considered in line with the changes in the global economy as well as the national economy and the government policy impact. And another thing is that to bring consistency, we do focus on the analyst also. We have the sector specific analyst team, and they are very much attached with different sectors for a particular point of time for independent and credible analysis. And we do focus on regular training activity of the analysts to upgrade their expertise, their knowledge, and we send them for training both locally and internationally also. And at the same time, it is also cross-checked by our internal review committee. Actually, it's a compulsion of our rules also to bring transparency and to bring consistency in the rating. We do, other than the updating the methodology, we do compare the methodology with the other rating agency, both the regional rating agency as well as the international rating agency. What factors do they consider, and in which cases they put more emphasis, and what are the changes that happen in that particular. Suppose in bank rating, S&P and Moody, they don't consider the subordinate bond in tier 2 capital. They do consider the tier 1 capital. So, but in local context, we have to consider both tier 1 and tier 2 capital. And so we also think actually what they are thinking about this particular entity, and what factors do they consider. Again, suppose to bring consistency among the consistency with the international rating agency, we see actually how do they assess the asset quality of a particular bank, because the true picture is not there in the audited accounts. Sometimes due to some unavoidable circumstances, it is not covered in the report. So that's why there is a difference with the local rating agency and international rating agency. And sometimes also there is a intervention of the legal system also to classify the assets or not to classify the assets. So we do consider all these factors in our rating process to bring consistency, so that our rating of a particular bank it may commensurate with the rating of other international rating agency. But here one limitation is that we don't consider the sovereign or country risks at that much level. That's why inconsistency sometimes arise. But other than that, there is a consistency in the analysis and the process that followed by our rating agency and process followed by the S&P or Moody. Thank you.
Here I want to add something. Here I want to add, coming to the point of Mr. Masuda, that our consistency, since we are a rating agency in Bangladesh having around 75 to 80% rating in SME, our concern is that to the public, general investors, say for example, A rating in the banking sector and a rating or a minus a rating in the SME sector, the people understand what is the difference. Is it equivalent to bank or something like this? This sort of questions frequently comes. So our what we address these things, that our internal review committee always try to have research on our ratings in across the sector and also within the sector. The other point, we are trying to bring the system under total ERP, so that our risk factors are equally weighted and ratings can be compared. So these are the things, normally, since it is our one of the major concern to bring consistency in rating, not only within the sector but also in the cross sectors vis-a-vis the requirement of the central bank for risk weight calculation in capital adequacy. All these together, actually rating consistency is a major concern for us in Bangladesh. This is my opinion. Thank you.
Muzaffar, don't you in any case have a different rating scale for SMEs as contrasted to corporate ratings? Don't you have different rating scales?
Yes.
You do have.
Yeah.
Okay. Because one idea, one thought I have really is consistency as a general rule is important for our credibility. But if we are talking about SMEs, perhaps consistency is less important than what I call customization of the factors, customization for SMEs. I can just imagine how different SMEs are across several industries, and which you don't find reflected in the corporate sector. So I just thought I'd mention that sometimes there are occasions where consistency is not really that important. And perhaps, I don't know, I'm just asking whether it is less important in SME ratings as it is important in corporate ratings.
Yeah, basically, you see, our ratings are being asked by the banks, the client rating asking for the banks, because which is linked with their capital adequacy. As a result, the general public or the banks at the branch level, they do not like to differentiate or go to the methodology how one rating is different, one sector rating is different from other. So although we have got the different rating scales for corporate or bank or financial institution or even the SMEs, even in the SMEs, even we try to classify and bring all the SMEs into a single platform. But having all these things, this becomes very important for us, and it has got a lot of franchise value in the market. People not like to go through our report, our methodologies or our scales, but they want to know that some bank, as I told you, some bank one got say A+, then why as SME organization, why that as A-? What is the difference? Is it the same? So all these things together puts us in a very embarrassing situation, and we try to bring conformity in our rating through all these measures from our internal review.
Sakin, you wanted to ask a question. I see your hand. Yes, please.
Sorry, are you asking me?
Yeah, I thought you were raising your hand. Oh, okay. It was something. All right. No, that was a mistake. I thought you were raising your hand. Okay. Are there any questions, comments from some other what do you call it? Some of our other participants? We are 75, all of us in this meeting right now. Any more questions? I know we're really doing overtime, but anyway, if there are no more questions, I know you have some questions there, but we are doing overtime, and all I can say is this has been a very comprehensive roundtable, and we could go on. That's why we have another CRO roundtable part 2 next month. But for now, we have to end somehow, and we are doing overtime already. So I would like to thank all our 6 resource speakers, Angel Viloria, Hendro Utomo, Mr. Paramesran Rajan, Dr. Roy, Mr. Mohamed Asiful Haq, and Sakin Gupta for a very, very interesting and comprehensive presentation. And you know, what are we going to do with all these presentations? This is a rich accumulation of knowledge and insights. So I will propose to our board really to prepare a kind of an ACRAA handbook on ratings issues and challenges along those lines, revisiting rating processes and updating practices, so that we have something, you know, beside us and share with our analysts to look over now and then, and check what has been said against what we are doing. So that's one idea, to preserve these very, very valuable contributions this afternoon. So on that note, I say thank you very much, everybody.